All right. Yep. Good morning, everybody. Who is here? All right. Chinanyana, welcome. Ify, Ajay, Kevin, Nancy, and Teresa. Oh, today we are seeing a visitor. Teresa, how are you?
So I'm alive, thank God.
He said she's alive. You're alive indeed. You're welcome.
Hallelujah. Thank you, sir.
You're welcome.
Thank
So,
you, sir.
who is here again? All right, so we're gonna go to where we started yesterday. All right, Kevin is back. All right. We stopped at chapter 4 and we intend to finish chapter 4 today. I hope. Is everybody hearing me? Is everybody hearing me? I know Teresa is hearing me. Any other person hearing me?
I can hear you, sir.
I can hear you.
All right, that's good.
Yes, sir. Good
All right.
morning.
Yeah, good morning. You're welcome. So let's go ahead. We're going to start from chapter 4, where we stopped yesterday. Our plan today is to finish up chapter 4. Of course, we are taking our study from Excel Solution. They provided this platform to study. So, and I hope some of us that have Excel Solutions equally read through what we're reading. We're just studying. All right. So, you remember where we stopped last night? It was about endowment policy or what? I don't think. Can anybody remind me where we stopped? I don't. Industrial home.
Tell us more about this honor is Eric Smollett, Senior Vice.
Juvenile. You said we're going to start with juvenile.
Juvenile. All right. Yes. Let me look for it. All right. Yes, that's it. So juvenile insurance.
All right, let's
one thing with insurance is that there will always be an insured and also the policy owner. It's always there. Even if the insured is the policy owner, we still have to have insured and the policy owner. That's the one thing about that contract.
It's a team sport.
The contract must have an owner and must have an insured. Even though
the best quality, the best outcomes.
Even though most often the insured can equally be the policy owner, and sometimes the insured may not be the policy owner. So that's one thing. So in insurance contract, there's always the owner. But in this case, when it comes to the situation that the insured is not the policy owner, I mean the policy owner is not the insured, you can see that in juvenile is somebody below 15 years by insurance, by the insurance purposes. It's somebody who is below 15 years is regarded as juvenile. And of course, we said it is regarded as age of maturity in insurance. The age of maturity in insurance is age of 15 years old. So if you are below under age of 15 years, now you are a juvenile. If there's any policy you have or your parents have for you, or the policy owner have for the insured who is 15 years below, that person is what? A juvenile. So when a juvenile have a policy, there is tendency that this person who is the policy owner, that person who pays the premium of the policy, that person who signs the contract may or may not be around to continue with the payment of the premium. And in that case, what happens to the policy? The policy will terminate. But for juvenile policy, there is this provision that is a rider that if you put it on your policy, what happens on that policy? Even if that policy owner, the parents or the guardian, as case may be, was not able to be there, then the policy will continue on. Of course, the policy will not be terminated. So today we're going to start with a juvenile insurance policy. The adult, that person who is the policy owner, who applies for that policy, is called premium payer. P-A-Y-O-R is payer. So if that person is not around, if you have that rider there, that person is not around due to death or disability, if you have the rider there, what happens? The insurance company, it becomes a third-party ownership where the insurance company will continue with the payment until the that juvenile is able to take care of the policy. So a juvenile policy is any type of ordinary life insurance policy that what insures the life of a minor. Applications for insurance and ownership of the policy rest with an adult. The adult may be the parents or the guardian. The guardian may be the aunt, the uncle, the cousin, anybody that has an insurable interest on the juvenile and don't require the minor's consent. So in juvenile policy, there is nothing like minor's consent. You just go ahead and do what you want to do. You are the policy owner. You decide what to do with the policy. There is nothing like consent from the minor. A minor is somebody who is below 15 years. However, in different states, they may have different age of maturity. So find out from your state the age of maturity whereby somebody can begin to sign consents for his policy. So as such, juvenile insurance utilizes the concept of third-party ownership. Additionally, the adult applicant is typically the premium payer. Though that person who pays the premium is called premium payer, at least until the child becomes of age and can take over the payments. That's what's happening in juvenile. In fact, the policy open for your child who is below 15 years is considered a juvenile. In Texas, it's 18 years. So if you put any policy for your child who is below that 18 years, what happened? That child, you are in control of that policy until that child will be able to take over the policy, until that child can be able to pay. So payment of the policy now depends on you, the policy owner, when you assume that this child or that child can be able to start paying for the policy, then you can hand it over to him or to her. I had somebody that give insurance policy to her daughter as a gift during her wedding. So such a wonderful gift for those who understood. That is the best gift you can give anybody. You know, the best gift you can give anybody, to give him a certificate of that insurance. Say, look, from today you are the owner. I have a policy of $1 million for you right from your birth, and I've been taking care of it today. So from today, I hand it over to you. You know, that's a very precious gift. So additionally, the adults typically the payer. Of course, we said who pays the piper takes the tune. Policy owner, the mom or the dad or the uncle, anybody that pays for the policy is the payer. So for life insurance purposes, an applicant is generally considered a juvenile if they are under the age of 15 years. However, some states use 16 as the age of maturity. So, which means you have to find out from your state, please. You may see it in the exam. Find out from your state. It may be 15 years, maybe 16 years, maybe 18 years. Just find out from your state. The applicable age of maturity will be discussed further in the laws and rules chapter of the end of this course. So let's look at jumping juvenile insurance estate builder. You see, insurance creates estate and annuity liquidates. So being an estate builder, juvenile insurance is an estate builder. When you start from time to make this, get this policy for the child, you have started building a very big, massive estate for that child. So in addition to purchasing insurance for a child burial expenses, insurance may also be purchased to protect the child's insurability. Of course, if you buy the policy on time, what happens? Maybe tomorrow there may be any medical issue that may disqualify the baby. But at least you have bought it. That one you have bought before the discovery of before the diagnosis. You have already crossed the border, so it's not going, they will not cancel it again. So that is the reason why we should have it on time for our children. Some parents purchase this plan to begin a saving plan for their child. Look, life insurance is an investment, but some parents purchase the plan to begin a savings plan for their child. However, life insurance is not a investment. So the first amount of this policy can start as low as $1,000. So tell me the reason why somebody could not be able to buy estate builder for the child. So the coverage amount jumps up typically 5 times the initial amount when the child reaches the age of maturity or a specified age. Age 21, this benefit increases without any evidence of insurability and no premium increases. However, that is jumping juvenile insurance estate builder. This is a kind of policy under juvenile insurance. I hope everybody understood that. So somebody can buy this one. Is purchased for a child's burial expenses. So somebody can buy this. Everybody will die. Everybody will die. So somebody can purchase this, be paying for it. Of course, it's your policy. You can do anything with the policy at any time. Your own may be for saving plan of the child. It does not mean because they call burial, it does not mean it must go to burial. However, it's assumed to be a burial estate builder. So, but see, some people buy it to start savings for their children because it's low. It's not expensive. So this benefit increase comes without evidence of insurability and no premium increase. You see, there is no premium increase, even from the type, which means if you buy $1 million estate builder today for a child, the premium remains the same. If that child is 2 years and that child is paying $1, well, that $1 will remain on forever and ever. There is no, and there will be no time they will ask for evidence of insurability. And there will be no time they will ask for no premium increase. What premium we have today is what we have forever. So some insurer may also refer to jumping juvenile insurance policy as a junior estate builder plan. So please note this. You have to know this. You have to note it down. Is under juvenile insurance policy. Estate builder. They buy it for child's burial expenses. And it goes as low as $1,000 policy, which means if you buy 500,000 policy, it's a big deal. So, and it should be very, very low. I mean, the premium will be very, very low. So the owner of payer, which the payer is the person who pays the premium, will not change automatically. In this case, the current owner, that's the parent or the guardian, must request the change, typically in writing with the insurance company. That's when you want to transfer to that child. When you want to transfer the policy to that child, probably that child at the age of 21 or even at any time, you have to write the insurance company, look, I'm transferring the ownership of the policy to my child. So some insurance, it is only required at the time of application. The parents or the guardian will never be required to relinquish ownership of a child policy. You see? So in law, you can never even be required to relinquish the ownership. You can be the ownership until any time you feel that you want to give it back to the child. As the parent, you remain the parent. The parent does not change, you know? So it's something good to have. Now, application scenario, that is they're talking about the juvenile. Let's assume Tina and Michael decide to purchase a jumping juvenile insurance policy for their 5-year-old daughter, Emma. So these are two parents. They decide to buy a jumping juvenile insurance policy for their 5-year-old daughter, Emma. The initial amount is $20,000. Monthly premium is $25 fixed. You can imagine that. $20,000, the initial first amount. And what? The monthly payment is $25. So I know our people be scared because they call it a burial. I think I'm correct. Everybody be scared because they call it burial. Eh? Well, but it's not really for burial. It's to plan what? To a saving plan for the child. People be scared because you say burial. Oh, they be scared. But look at the price. $20,000, $25 a month. And because he decided to buy $20,000. So policy report says age 5 years old, jump age 21 years old, jump multiply 5 times. So you can now multiply the first amount by 5. However, what remain? The premium remain the same. If you multiply 5 by 20, how many give you $100,000? You can't. In fact, you can't beat that. I'm telling you, you can't beat that. Wow. I didn't notice. I'm seeing it for the first time, telling you the truth. Wow, jumping juvenile policy. All right. That's wonderful. So what happened at age 21? At age 21, first amount automatically increases from 20,000 to 100,000, which is 20,000 times 5. Monthly premium remains at 25,000. I mean, $25. And no medical exam or proof of insurability required. Guaranteed insurability regardless of a man's death at age 21. Come on. All right. Yeah, I'll be trying to talk to my customers about this. This is so good. It's not really about, you see what they say? It's not really about, sorry, please. Yeah, how can I be? Oh, okay. All right. So, sorry, please. So, you see, that increase what amazes me. The $25 remain the same, and the price goes down to $100,000. I think it's so good. Let's see. Look at the benefit. One of the benefits is protection. Provide immediate coverage for burial expenses if needed. If needed. Of course, everybody will die. We're not praying for the child to die. No, not at all. But however, is a burial expense. Guaranteed insurability ensures a man can have substantial coverage in adulthood regardless of our future health issues. Look at it, it's good. Fixed premium, the 25 monthly premium remains constant even after the coverage increases. Cash value, the policy built cash value that a man can access later in life. Financial head start creates a foundation for a man's financial future. So why this? So it is like there's no need to think about it as what? As burial insurance. No, after all, every insurance is still the same. If you decide to buy fixed index life insurance, it's still for burial. If the person dies, won't they use it? They still use it. So I do not see anything wrong with this policy, this kind of policy. Honestly, let me see, jumping juvenile insurance policy. I'm gonna write it down. To me, it is good. Yeah, I'll ask some of these carriers whether they offer it. Yeah, this is good. All right. So when you have your license, this is one of the policy you can easily give to anybody, to any parents, to their children, as far as the child is juvenile. This is so good, I'm telling you. The most critical, the most good thing about it is because of they will not ask evidence of insurability, and when the first amount increases, they're not going to increase the premium. So it's so good. All right. Let's look at industrial home service life insurance. Industrial home service. We remember we have talked about maintenance life insurance policy. We talk about income policy, family income policy. So this is industrial. That is home service. Of course, at anybody who have mortgage here, we understand that inside their home, apart from the home insurance, they still have some insurance that covers the equipment, all the equipment in the home. For instance, your air condition, your heater, your fridge, your washer machine, all those, you still have insurance that covers them. So industrial life insurance is what characterized by small issue amounts such as 1,000 with premium collected by the agent on the weekly or monthly basis at the policy owner's home. So this one is the old method. Of course, not even old method. In our community, some people still call it jangi. You think jangi or what? Where people goes around to collect money, contribute, a contributor contributes, it passes to somebody. So it's just the same thing with this industrial life. People goes around to collect the premium. The premium can be weekly or monthly. They go to people's home to collect it. So this insurance is often marketed and purchased as a burial insurance, but may also include dismemberment benefit or benefit multiplier indemnity for accidental deaths. So this is typically what those who come from Africa, we normally do those in Africa, but we don't really put much mind on it. Some people do contributions. This is exactly what it is. It's contributions because the premium is paid weekly or monthly. I know in my place, they do it is every market day, which is every 4 days. Every 4 days, every market day, every 4 days. They do the contribution. Then they give it to one person. So after that person, it mature for another person, something like that, they will transfer the service. So I don't think you're going to see question on that. So let's look at endowment. An endowment policy is a type of life insurance that provides two potential benefits. Endowment policies. Death benefit if the insured dies during the policy term, or maturity benefit equal to face amount if the insured survive to the end of the term. That is endowment. So, what I found out from life insurance that if you really understand it, you have so many types that you can put your hand on and you benefit out of it, honestly. So it's not only what we know, our knowledge is only in one, that, we buy life insurance just for in case somebody died. No. So endowment is what? Is a financial gift or pool of assets. Endowment is a financial gift or pool of assets that you can donate to a non-profit organization like universities or hospitals for a specific long-term purposes. So you do it for universities. Have you at least one or two of us have understood where somebody donates some money to universities, donate to hospitals, or come from these endowment policies? It's a type of life insurance that provides two potential benefits. A death benefit if the insured dies, a maturity benefit equal to the face amount if the insured survives to the end of the term. So they have what? Maturity benefit and the face amount. The maturity benefit, when it matures, now the face amount of the benefit is what comes to you. So most people see them donating huge money to organizations, particularly non-profit organizations. Most of that money comes from the policy opened for them by their parents, which endowment policies. So when they come up and begin to do that donation, you think probably is from their own personal savings. No, that money already kept there for that donation. So that's endowment policy. We have types of endowment policies: standard endowment, semi-endowment, and the pure endowment. Standard endowment pay full benefit either at death or maturity. Semi-endowment pays 100% at death, 50% if insured survives. Pure endowment pays only if the insured survives. Juvenile endowment specifically designed for children's education. So, see, people donate a huge amount. Sometimes we thought probably these people have a lot of money. It's money already meant for such donation. This money is definitely kept from beginning for such donations. Imagine somebody opening endowment policies for their child when the child is small. You open 20,000 or 50,000 endowment policy for your child, and you are paying for it. When that child grows old up to 60 years, that child now can reach age of maturity and now take the money and donate to any organization he feels he likes to. And people who owns the land where we are, they are very honest. If their parents open those policy for them, definitely they're going to donate it to organizations that their parents said, or even the one they like. They're not going to use the money. They will donate it because it's specifically meant for such organization. So taxation of endowment policies. Due to Tax Reform Act of 1984, policies that endure before age 95 no longer qualify as life insurance for tax purposes. This has led to a decline in their popularity since they no longer receive favorable tax treatment. So from 95 years, this one for endowment policies.
Sir, that jumping, I'm interested in that juvenile jump. Can I copy? Can you go back? Let me write it down. I want to discuss something with Dr. Ruth.
All right. All right. Jumping juvenile insurance, estate builder.
Yeah.
Yeah, that's good. It is a very good policy, I tell you. The increase is what amazes me, and no increase in premium. That is what I so much like on it. It's good. All right.
Okay, go ahead.
Yeah. All right. So modified endowment contracts. We have said much about this modified endowment contract. We're not going to waste our time there.
No.
Let's go ahead.
Yeah.
So the only thing I want you guys to know is that let's look at it. The following are illustration of tax treatment of benefit distribution from a MEC. For those who are not here, endowment, modified endowment contract. Sorry, please. So the modified endowment contract we are talking about is, we have said it, if you overfund your policy, it now remove that that tax favorable tax issue that's that's in life insurance. No, life insurance is tax-free. So, but if you fund your policy, the IRS will see it no longer as a insurance policy, but rather as what? As an investment. So they'll begin to tax it. They'll tax any withdrawal you did there. If you do any loan, they will tax it. So that's what we call modified endowment contract. I think, how many of us here? 10? I hope everybody here will be coming to Champion Bowl in Dallas. I believe so. He has declared that if you can find yourself at Dallas, Royal Star will pay for your hotel. So that's a gift. So anybody who find himself in Dallas, February 5th to February 7th, the hotel bills will be paid by Royal Star. What it means, you register so that your hotel will reserve for you. Your own is just to buy your ticket and come to Dallas. Come and see what people are doing, you know. Anyway.
Are you serious? Oh my God, you mean
it? Yes.
I can't wait. So the days, how many days or just one day?
No, it's February 5th, 6th, and 7th.
Are they gonna pay for the 3 days?
Of course.
Oh, okay. All right, I'm getting my ticket.
So what you're gonna do? I think Dr. Ruth will still coming to talk to you guys about it. Just put in the sign in and so that we can know that you are in. We now make arrangement for your hotel immediately.
All right. Thank you. That's the good news.
All right. So so I'm not gonna go far more on endowment. The only thing we're gonna look at endowment is what? Let's look at the taxation. How the taxation come about? Taxation only occurs when any cash is distributed to the contract owner or money is withdrawn, whether by surrender, loan, or dividends. So you do not want your policy to go to that extent where what? Taxes will be leveled on it whenever you make a withdrawal, whenever you take a loan, or even when you surrender. Remember, when you surrender, apart from the surrender charges, you have your cash value back, non-forfeitable. You have it back. Now, if your policy is MEC, they're going to tax that cash value that is given back to you when you surrender your policy. Or if you take a loan, normally in life insurance policy, the loans are tax-free, the withdrawal are tax-free. Even look at the dividends that the mutual company will pay you. The dividends is tax-free. But if your policy becomes MEC, what happens? The dividends now will be taxed. So you do not want your policy to go to that extent, please. Now then look at the gain. The interest of appreciation is taxable first when distribution is made, which is what we call LIFO. The gain, that is the interest or appreciation, any increase is taxable first when a distribution is made. Distribution can be you make a withdrawal, the interest thereof is taxed, which is called LIFO. The first dollar covered by the contract owner are considered earning first. Excess amount of cash value beyond premium and are taxable. In fact, nobody wants to go through this. By the time they do all the taxes, your money will go. So if a policy is a MEC and cash is withdrawn, appropriate amount are still taxable. Even it will be used for legitimate reason, such as financial hardship or to pay medical expenses. Oh my God. You don't want to do that. If a cash is withdrawn prior to age 59 and a half, a 10% penalty tax will be assessed. In terms of, so it's just acting like a 401k. So I think whenever you're financing your policy, make sure you do not go through it. And the purpose, let's look at, I want us to read out this so everybody will know what it means, what 7-pay means. You'll be hearing 7-pay, 7-pay. In whole life insurance, policy is a modified contract if the total amount of premium paid during the first 7 years of the contract exceeds the total amount of premium required for the same insurance policy to be paid up in 7 years. Did you see this? So that is what we call overfunding. You see where I highlighted? If you do this, that is overfunding. If you have a policy, remember, the agent will always ask you to do 7-pay, which is so wonderful because what? We want you to start building up cash value immediately. It's a very good way to save, to make some savings, although we say it's not an investment. So the 7-pay test is limitation or the total amount a person can pay into a policy in the first 7 years of its existence. The first 7 years of that policy existed, the total amount of money you can put into that policy. If it exceeds it, what happens? Becomes a MEC. So let's assume you have a policy, 500,000 policy. They calculate the 7-pay to be maybe $100,000. And you go above that $100,000. Now it becomes a MEC. In the first 7 years, the total amount you put that policy may be probably around $100,000. If you put $101, it becomes a MEC. So you can see how the billionaires are saving money, are hiding money. You can, in fact, nobody needs to tell you. This is a way they are putting money aside without anybody giving them headache. Imagine if you have a $1 million life insurance policy, imagine what the 7-pay will be. The 7-pay will be close to 500,000 or 400,000. Because in the first 7 years, the total amount you can put in that policy may be around 400,000. So somebody who have $1 million policy can put 1.4 million at the same time. I mean, can put 400,000 at the same time. You can see. And the rich do not buy $1 million policy. The rich buy 50 million, 60 million, 100 million policy. I've known somebody, Daniel, from probably some of you will see him if you come to Dallas. He had one single policy of 50 million.
$50 million.
Yes.
Hey.
One single policy. One single policy, $50 million.
But it doesn't look like somebody that has money.
No. Very simple. Oh, you have seen
His appearance.
Very simple man.
Very simple.
You thought he's auto shop guy.
Yes.
He has one single policy, $50 million. One single policy. So if you calculate the policy that is in his own house, you're talking about close to 500 million. Hey, it's good to
It's
be
made
rich.
for life. It's made for life.
It's good to be rich. So that is what we call 7-pay. So now you understood what 7-pay is the total amount of premium you can pay in the first 7 years of the contract, of the policy. That's what we call 7-pay. So you can ask your agent, what is the 7-pay in my policy? That 7-pay is the total amount you can put in that policy for the first 7 years. So, no, who is this person? Sorry, please. Hello, can I help you? Yes. All right, please, sorry, please. Is this children, you know? So I think everybody have known what MEC is. 7-pay is. It's good to know because when you start the business, that's one of the things you'll be telling your clients. You want to tell your client to know this is the maximum you can put in the policy. It's the best way to save some money. It's the best way to plan. So if you put a 7-pay in your policy, what happens? That policy, the cash value will start immediately. It starts giving you good cash value. Just like when you pay annually compared to somebody who's paying monthly. You pay annually, the cash value starts generating within the next 2 years. Then
Hello,
imagine when you pay 7-pay.
Sorry, sir. Is that a rider?
No, it's not a rider.
Okay.
It's not a rider. It's a way. You see, can you guys remember this footballer who dies, who they accuse killed a wife, something like some time ago. This footballer they accused that killed his wife.
O.J. Simpson.
Good, O.J. Simpson. Yeah. This is what kept that man alive until when he passes. You know, of all those cases he have, he came out, he's still very rich. Of every cases O.J. Simpson has, O.J. Simpson came out and still very rich until he died. I think he died last year or what? So if anybody has money, so those rich people, they do 7-pay to keep their money. Because this is still your money. If that cash value is generated, you can still go there and get money to do whatever you want to do. The only thing is not a saving plan that if you go there today, tomorrow, you pick the money. No. So it's not an emergency fund. That is the only thing. Life insurance is not an emergency fund. All right. So these are the benefits. We should look at it. I think it's very good. Now, modified endowment contract scenario. We don't want to go through it. We have looked at it before. It's a scenario of modified endowment contract. Other life insurance products, face amount plus cash value. Everybody knows what face amount is. Face amount is that amount you bought is face amount. If you can be able to afford $100,000 policy, that is the face amount. That is the cash value. That's the face amount. That is the face value. That is the death benefit. So a face amount plus cash value policy is a contract that promises to pay the policy face amount plus the cash value upon the death of the insured. A face amount plus cash value. So imagine, people, imagine that somebody have $1 million face amount policy, and that person is paying the policy for at least 50 years or 20 years, even 10 years. And the cash value that must have been generated there, maybe, let's assume $1 million, cash value must have more, which is around 700,000. So the person passes. Then the beneficiary will get what? The face amount plus the cash value. It's not, you have already made that family. See, that's why, what they call it? That's why suicide is regarded as an exclusion. Because some people can just go and die for the family. I said it several times. Some people just go and take $5 million policy. The next they die to make sure that everybody in the family is met. Yeah. So that's why suicide is regarded as an exclusion in life insurance. Because people have a bad thought. People have a bad thought. So accidental death and dismemberment, AD&D. This policy can provide financial benefit if an insured is killed, loses limb, suffers blindness, or is paralyzed in a covered accident. Of course, we have discussed about AD&D before. Non-medical life insurance does not require a medical exam and tends to be more expensive than medically underwriting policies. So this non-medical life insurance, you will not go through medical underwriting processes. But the medical life insurance, which is the one all of us are doing, you have to go medical examination. That's the one that will draw your blood, begin to search your information to know whether you are sick and the kind of sickness, to know the medical condition, whether it will result to higher risk classification. That will determine your premium. Participating versus non-participating. We have talked much about participating and non-participating. Participating is when you have a policy in mutual companies. We always say mutual companies say participating policy, and stock companies say non-participating policy. So you should know this. This normally is an exam question. Participating policy and non-participating policy. Who says participating policy is what? Mutual company. Who says non-participating policy is what? Stock companies. So I think you should know this. And why do we say mutual companies says participating policy? Because mutual companies share their profits. Any profits they make, they share it with the policy owners in form of dividends. That means if you today have a policy with any mutual company, if end of the year, as the year just ended last month, they calculate all their check and balances and found out that the company made profit. You, as the policy owner, will follow to share the profits in form of dividends. If you just have a policy with them, invariably, you, as the policy owner with the mutual company, you will follow to elect who will be the board chairs of that company. You follow to elect them. So you can see you are just a member, board owner. I mean, if you are the co-owner of the company. If you can share the profit and you have the right to do a vote, then you are part owner of the company. If you have policy, for just having policy with mutual company, the most good thing about it is the dividends they share, the profit they share in form of dividend, which you can accumulate, which you can cash out, which you can use to buy more policies, which you can use to pay your premium. That dividends they share to you, the profit they share is for you in form of dividend. You can allow it to accumulate for you. You can allow it to do what? Cash it out. You can say, give me the money, that dividend, give it to me. You can say, oh, that dividend, use it to pay for my premium this month or next month. Or if the dividend is big, use it to pay my premium for the next 4 months. Or you can say, oh no, can I use it to buy more policy? They will use it to buy term policy for you. So many ways to benefit if you have a policy with mutual companies. If you have a stock policy with stock companies, you do not participate in sharing any profit in form of dividend, no. And that's why they say non-participating policy, that is the stock companies. The profit from stock companies go to the shareholders or the stock owners. All right. So those things you expect to see them in the exam. Strangers, investors own life insurance policy, Stoli and Ole. So these are another two ones that sometimes most people get confused about them. So we're going to look at them now. Stranger own life insurance, Stoli, is essentially a scheme whereby strangers to the insured, those without any true insurable interest. So if you have a policy, normally before you put policy on somebody, you must have insurable interest. But when a stranger is coming, they don't have any insurable interest to that person. They originate a policy for their own financial gain. That's why it calls strangers or investors life insurance policy. Normally, the law is that before you have policy for somebody, you must have insurable interest on that person. And what is insurable interest? Is that thing that can make you lose financially or otherwise on somebody if anything happened to that person. That means that you have insurable interest on that person. But a stranger's or investor's own life insurance solely, you do not need to have insurable interest on somebody. You just put policy on that person. More especially for your own financial gain. So you see, to me, it's risky, and that's why some states prohibit it. They don't want it. Some states don't want it to exist in their states. Because what is a scheme? To them, it's a scheme on human life, so it's prohibited in most states. These people, to legally purchase insurance on another person, the purchaser must have an insurable interest in that person's life, of course. But Stoli policy, we are a way to circumvent the insurable interest requirement when purchasing a life insurance policy. You could imagine. So if today, but I'm going on the road, I see somebody, I just put policy on that. If I ask him his name, he tell me his name, I just put policy on that person. So there's so many bad things that can result to it. So that's why most states do not tolerate that. Most states ban it from their state. They don't want it. That's strangers' own life insurance policy. It circumvents what? Insurable interest. Then investors own life insurance OLE is a life insurance policy that covers the life of an individual who is unrelated to the policy owner, either by familiar or economic ownership. So investors and the strangers, I don't see any difference there. It's the same thing. The investors,
There's no difference between the two now.
yeah, the investor pays the person's premium in exchange for the person's life insurance benefit. And only what transaction is very closely related to STOLE transaction. The primary difference between the two is that an investor always initiates an OLE. So they are the same thing. It's just that in this OLE, the investors initiate it. Both STOLE and OLE are considered fraudulent. So STOLE and OLE do not include lawful life settlement contract, provided that such contracts or practices are not for the purpose of evading regulation. So some states don't want it. Some states do not want it. To them, it's a fraud. It's fraud. Some states is fraud. They don't want it. I think we are done with this. So let's watch this and we go to chapter 5. All right.
Congratulations on completing the life insurance policy types chapter. You've just taken a major step toward becoming a knowledgeable insurance professional. Let's recap the key points that will help you prepare to pass your licensing exam. Life insurance transfers the financial risk of death from the insured to the insurer. It creates an immediate estate and provides peace of mind for families and businesses. Let's talk about term life insurance. Term life insurance provides temporary protection at a lower cost. It's especially useful for short-term financial needs like covering debts or replacing income. Here's what makes it a smart choice. It typically comes with lower premiums than permanent life insurance. It offers higher coverage for minimal cost. And it's flexible, allows selection of a term length that fits specific financial goals. Next up, whole life insurance. This is a type of permanent life insurance that stays in effect for the insured's entire life, as long as premiums are paid. Unlike term life, whole life insurance comes with fixed premiums and a guaranteed death benefit. But here's what really sets it apart. It also builds cash value over time. When reviewing whole life insurance, it's important to understand that both the death benefit and the premium remain fixed for the duration of the policy. Additionally, the policy builds cash value over time, and that growth is tax deferred, meaning taxes aren't owed on the gains while they accumulate. Typically, the policy matures when the cash value equals the face amount, which usually occurs around age 100. Now, some life insurance policies are considered non-traditional because they offer more flexibility than standard plans. These policies allow adjustments to premiums, death benefits, and even investment options over time. Examples of these flexible policies include universal life, which allows for changes in coverage and payments, indexed universal life, which ties cash value growth to a market index, variable life, which includes investment choices within the policy, and modified or graded premium whole life, where premiums start lower and increase gradually. Some life insurance policies are designed to meet specific needs, such as providing coverage for a family, 2 individuals, or even children. These tailored plans combine different types of coverage to match unique situations. For example, a family income policy blends whole life insurance with decreasing term coverage to provide income over time. A family maintenance policy pairs whole life with level term coverage to maintain a steady income for a set period. In cases involving 2 people, joint life insurance pays out upon the first death, while survivorship life insurance pays after the second death, often used for estate planning or legacy purposes. Modified endowment contracts are life insurance policies that have been overfunded, causing them to lose favorable tax treatment. If a policy fails the 7-pay test, it becomes a MEC. That means distributions could be taxed, and loans taken before age 59.5 may face penalties. As you wrap up this chapter, take a moment to review the notes in the next section, talk through the concepts with someone else, and complete the practice exam. These steps will help reinforce your understanding and prepare you for success. Great job finishing this chapter. You've built a strong foundation in life insurance policy types, knowledge that will serve you well both on the exam and in your career. Keep up the momentum, and I'll see you in the next chapter.
All right. So, we're almost there. Let's let me see. All right. So let's look at the questions quickly and see what we can do on chapter 5, life insurance provisions, options and riders. Very, very important chapter, chapter 5. So let's look at the questions here. I think there's about 7 of them. Oh, 22 is big. So let's answer it. So remember how to answer these questions. I said it always. You don't need to waste all your time on answering one question, and before you know it, time will catch up with you. When you look at questions like this, it's always 4 options. In exam, it's 4 options. Look at the questions, look at the options. Check within yourself which of the options you think does not even warrant you wasting your single time. Remove it from your mind. Don't even look at it. Remove it totally. Then fight between 2 options. Those 2 options, the chance of you getting the correct one is there, even if you don't know it at all. If you don't know the question, at least you will have idea what you think that is not totally supposed to be there at all. You remove it, then fight on the other 2. Because in a single question, if you don't understand the question, if you don't know it, you now see some of the options on the things you know. Your mind have told you, no, this thing may not be related to this question at all. Remove them. Then fight on the other 2. If you fight between 2, the chances of you getting the correct one is very high. It's 50-50. It's 50-50. So just go do it, elimination method. We call it elimination method. Use it to answer questions. It will help you. You pass, honestly. So let's look
I'm taking B.
Let's look at this. He said, what is the first amount paid under joint life and survival policy? What's the first amount paid?
Upon the death of the last insured.
Any other person? Any other person? Let's contribute to this. We'll do it fast and go to 11.
Yes, she's right. Because if Mr. A is married to Mr. B, Mr. A dies, so the money, let me see, the money will not go out until Mr. B dies. I mean, until the spouse dies, and then they will give the money to the kids, or to the beneficiary.
You see, the explanation you give now is what I want everybody to know. Immediately you see joint life and survival policy. Survival means the money is going to the beneficiary. And that money will go only to the beneficiary when the last person dies. That's what you should know. In fact, you will see this in the exam. There's no two about that. Then when you have only joint life policy, what it means that the policy is between 2 people. Now, if the first person dies, the second person will collect the benefit. But immediately you hear joint life and survival policy, it means it's talking about the 2 persons must die before the benefit will go to the beneficiary. So now whole life insurance policies are contractually guaranteed to provide each of the following except. So we discuss whole life well. What can whole life not provide in this scenario?
D as in Delta.
Another person?
D as in David.
All right. So 2 persons a day. All right. Let's look at A. Premium that remains fixed for the life of the policy. In whole life policy, the premium does not change. It's fixed. It's level. It remains the same. Cash value, of course, cash value will ultimately replace the death benefit. Remember when we said that whole life, the policy term, the policy matured at what? At age 100. At that time, the policy face amount is equal to the cash value. Now, non-forfeiture benefit option. Of course, it has non-forfeiture benefit option. That cash value is non-forfeiture benefit option. The cash value. You cannot forfeit the cash value. If you surrender the policy, that cash value will be given to you. Remember, cash value is part of your premium. It's a single part of the premium you paid. So it's given back to you. Now, stranger-owned life insurance totally is when a person purchases life insurance only to sell to what? We just finished Stoli now.
Yeah.
A as an apple.
Any other person?
A as an apple.
So it's third party with no insurable interest. Remember, that's why some states banned it.
And that's why they said it's fraudulent.
Yeah, it's fraudulent, yeah. Who benefit investors originated life insurance only when the insured dies? Who benefits? Remember what happened in Stoli. It's the same, I mean, always, it's the same thing as Stoli.
In short,
Who benefit when the insured died?
the beneficiary.
Beneficiary.
No, that's it.
Does everybody say beneficiary? Are you sure?
Yes, B.
I'm not
It
sure.
can't be B. It can't be B.
Policy owner.
The policy owner, remember, the policy owner is the investor. The investor come in and he use somebody he doesn't have insurable interest on. He buy policy on that person and he spend the premium. So if the person dies, he collect the money. That's why it's fraudulent. There's no beneficiary there. The investor is the owner and the beneficiary. No, nothing like a beneficiary there. In Stoli and Ole is the same thing. The investor, the stranger originated, the investor originated is the same thing. In the stranger originated, the stranger is the policy owner and the beneficiary. In investor originated, that investor is the policy owner and insure the insured. If the insured dies, he will collect the benefit. That's why most states don't allow it, because you know what happened? It's likely there's a chances that that policy owner or the investor may instigate the death of the insured to get the benefits. So it's fraudulent. Since you don't have any insurable interest on that person, by law, you do not supposed to put a policy on that person. You don't have insurable interest on the person. So is the policy owner, is not the beneficiary. There's no
So
beneficiary.
I have a question, right? The beneficiary is some person with the insured?
No.
No. You see, all right, when you say investors originated life insurance or strangers originated life insurance, it means that in normal life insurance, the policy owner can be the insured, and the insured sometimes may not be the policy owner. You understand that? Did you understand that? I used to use
Yes.
All
yes,
right.
I'm here.
So now, in strangers originated life insurance, again, apart from what I just said, another thing I want to put there is this. Do you know before you buy policy on somebody, you must have insurable interest? You know that?
Yes.
Do you know what is insurable interest?
That's like the interest you get after the premium, depending on how long.
No. No, that is not the insurable interest. Who knows what is insurable interest here?
Insurable interest is somebody you have at heart. Somebody that if something happens to the person, it will affect you, it will pain you. That's insurable interest.
You would have a financial loss and otherwise on that person, both stress, loss, and everything. That's insurable interest. What it means is this: you cannot put insurance on anybody. By law, you do not have insurable interest on. But in strangers or investors originated life insurance, they don't have insurable interest on the person they put insurance on. They can see a stranger and put insurance on that person. So waiting until when the person dies so they can collect the benefits. So there is nothing like beneficiary. They are the policy owner and they are the beneficiary. They put policy on that person. They are the policy owner. The insured is the person they put policy on. If the person dies, they collect the benefits. Did you understand that?
Yeah.
Yes.
You get it now? So
Yes.
you got to start from knowing what insurable interest is. You got to start from knowing who is the beneficiary, who is the policy owner, who is the insured. So this case, the insured is that stranger that the investor or the stranger put a policy on. That person, that particular person who they've just go and put policy on that person, and they
Is
don't
the
have
insured.
insurable interest.
Insured.
Yeah, the insured. They don't have
Okay.
insurable interest on. You cannot see somebody walking on the road, you put policy on that person. No. The person you put or you buy insurance on, you must have insurable interest on that person, which means you must somehow related to that person in blood by any means. If that person passes tomorrow, you will have a financial loss or you have even a stress loss. You feel the pain that this thing has happened to that person. So such person, you have insurable interest, and that's the person you can put insurance on. All right. So let's go ahead. This one says, which of the foreign life insurance policies combine term insurance with an investment element? Combine term insurance with an investment element. Hmm? You can just looking at this question, you can throw away two. Two has to go. If you don't even look at it at all. You throw away two.
I think it's C.
Why? Is there any reason why it's still C?
Because there's increasing and decreasing. So I'm throwing away B and D.
Another person?
No, I'm still checking. I want to be sure of what I'm going to say.
Anybody supporting her? She says C. Anybody supporting her?
I'm not supporting because you say combine. When you're combining something, you're not increasing.
Okay, maybe it's A
So,
then. I don't know. Very confusing. I just want us to move on. That's why.
All right.
Answer is B. I'm taking B, universal life.
All right. Any other person supporting B or C?
I'll say A or B too.
My
Who's
answer
one?
is B. Bravo. Chinoyem B.
Another person?
B as in boy.
All right. Yes, of course. It's B, universal life. Remember, when you say you have life insurance policy combined term insurance with investment element. What is that investment element in life insurance policy? Who can tell me? What is the investment element? Remember, we say life insurance is not an investment, but what is an investment element in life insurance? What is the investment element? Why everybody wants it now?
Cash value.
Of course, the cash value. The cash value is the investment element in life insurance policies. Please know that. So if you look at these options now, you think which of them has a cash value? It's only universal life. Increased term life does not have investment element. Does term life have a cash value? No. Increasing term is a type of term life. Decreasing term is a type of term life. Graded is in there. So there is no way, there's not like in graded self. So what each from this option, it's only universal life has what? Cash value attached to it. That cash value is what we call the investment element in life insurance. Please note that cash value is the investment element in life insurance. Because of that cash value, that's why most of us can buy policy today, which means you're adding protection to a sort of saving plan for yourself. And what is that saving plan? When you pay your premium, part of the premium goes to the cash value to build cash savings for you. So that's the investment element.
What?
So this one,
Oh, okay. That's good.
this one said J is 35 years old and looking to purchase a whole life insurance policy. I'm gonna mute somebody who's speaking, please. All right. J is 35 years old and looking to purchase a whole life insurance policy. Which of the following types of policy will provide the most rapid growth of cash value? I'll see whether somebody will remember this.
B as in boy.
Any other person?
It's B because you're some lump sum.
All right, 2 persons said B. He forgot.
Jesus.
You guys just forgot so quick. You remember when we said pay?
Okay.
20 pay, 10 pay.
Limited pay hold. Limited.
So when it's limited, when you are talking about generating cash value, you are talking about which of them fastly can start generating cash value.
No, the way they twist questions.
So that is why if you are paying your policy, you are paying monthly, and somebody who's paying annually, and somebody who did 7 pay, which of them do you think can generate most cash value? Somebody who paid monthly, somebody who paid annually, and somebody who did 7 pay. Which of them do you think can generate cash value fastly? Or most cash value? Huh?
7 pay now.
7 pay, yeah. That's exactly the question. What the question is all about. This person pay 7 pay, 20 pay life, which will by 20 years the policy is paid off. Straight life, it does not have any limit until the person dies. Life pay up to age 70. He's paying up to age 70. This increasing term to age 65. This one of 12 pay will generate most rapid growth of cash value because by 20 years already paid finish. So the cash value will be more on 20 pay life. The shorter the pay period, the faster the cash value. The shorter the pay period, the faster the cash value. Of course, it's involved even in your auto and home and all that things. If you pay shorter, you gain more. All right. So who has the option to renew a renewable term policy? Who has the option? Who can do that? A renewable term policy. Who has the option to renew a renewable term policy?
It's insured now. The owner
I'll
of the
say A.
All right. So the insured, remember we said sometimes the insured is the policy owner. Remember? Sometimes the insured is the policy owner or the policy owner is the insured. We say it always, the policy owner be the insured. But sometimes the insured cannot be the policy owner. I hope everyone knows that. The policy owner sometimes is the insured, but sometimes the insured may not be the policy owner. When you insure your child is an insured, you are the policy owner. When you insure yourself, you are the policy owner, you are the insured. So sometimes the insured can be the policy owner, and sometimes the policy owner cannot be the insured. So you know that's why I used to say it always. A question like this will help you to answer that. At age 45 and his wife, K's age is 45 and his wife, age 43, have 3 children, they purchase a family policy that covers K's wife to age 65. All the situation will pay a death benefit except what? Remember K what? K age 45 and his wife age 43 have 3 children. They purchased a family policy that covers K's wife to age 65. Say all of this station will pay a death benefit except what? Which of this station cannot pay death benefit?
And cats.
Any other person?
Because at 66 years, he doesn't have any policy.
Yeah.
I think some other person says see in the chat.
Yeah, you see CS and cat.
66 years, no
Yes. Yeah,
policy.
somebody says yeah. 2 persons says here, I think.
Yeah, CS and cat.
Of course, at age 65, remember, the policy will cover until when K's wife reach 65 years. Does he have policy at 66 years? No, he doesn't have any policy, so there will be no death benefit. So life insurance immediately creates estate upon the death of an insured. Which of the following policy is characterized by a guaranteed minimum death benefit? Guaranteed minimum death benefit. Which of them is guaranteed that you must get your death benefit? Guaranteed minimum death benefit. At least 2 supposed to throw away 2 immediately. Somebody say, Austin say C. Somebody say C.
No, A.
Any other person? Somebody say C. Somebody say A. Any other person?
A.
All right, 2 persons say A. All right. C, variable life.
Okay.
The correct answer is variable life. Remember, variable life is a type of policy. The variable life insurance. Yesterday, I hammered on it. We said you cannot say a variable product. But however, we have variable life insurance policy. I hammered on it yesterday. I think I remember I talked about it yesterday.
Yeah, you talked about it
Yeah.
yesterday.
I talked about it. So not whenever you see variable, look at the attachment of product and life there. So that will help you to know when they're talking about product and when they're talking about life insurance. Now, a 15-year-old mortgage is best protected by what kind of life policy? A 15-year mortgage is protected by what kind of life policy?
D as in David.
Any other person? I think somebody say B. Austin say B.
D as in David because of the decreasing term that has to do with mortgage and
any other person? Any other person?
D as in David.
I think 2 persons said D. See, anybody who is here have heard this kind of question. As far as I'm concerned, as far as I'm the moderator here, if you've heard this kind of question, then there's problem. Honestly, you do not need to look at it twice.
Engineer is not a problem because some people just join newly, they don't know much about it.
All right. So I say it once again. We have 3 types of policy that exist in what? Term life insurance. 3 types of policy that exist in term life insurance. One is what?
Level term.
Level term.
Increasing term and decreasing term.
Correct. So these 3 types of policy, in every type of insurance, we have the type of insurance we have is what? Term life and whole life. Whole life can be called permanent life. So that's the 2 types of insurance we have. Now, in each of these types of insurance, there's a policy types attached to them. So for term life insurance, the types of policy you can get in term life insurance are level, increasing, and decreasing. And we said increasing and decreasing is all about loan and debt. But more especially, decreasing term is regulated with mortgage. So anytime you are answering the question and see decreasing term. Look to see whether you can see mortgage. If they are referring to mortgage, the answer is decreasing term. So please, this is something you have to know it. It should be a takeaway in the exam if you see it in the exam. Anytime you are seeing, you are looking, you see any question talking about decreasing term, and you look, they are talking about mortgage. Mortgage is the answer. Then the increasing term, they are talking of loan.
So senators who I've seen some folks.
You use increasing term to pay off loan.
If you are banking
So
on
please, the level term is the prominent one term of policy people, everybody's buying. That's the level term. That's what everybody's buying.
It's just the end of it now. It has to be. And Americans need to step up now. It's not enough to go to the streets. It's not enough
This
to
person now.
I move the person. All right. So look at this. The most important factor to consider when determining whether to convert term insurance at the insured's attained age or the insured original age is what? What are the most important factors to consider when you want to convert term insurance at an insured attained age?
The
or
health
the
of the insured.
original age is what? What do you need to consider? When you're trying to convert, what do you need to consider? To you as a person, what do you think you can consider? Somebody say B. Right, Austin say B. Another person who supports him. Two persons say B. As an agent, or even you yourself, if you are trying to convert your term insurance to your another insurance, what do you think you have to consider?
Cost.
Somebody say cost A. Any other person? All right, so two persons say A. So Joy say
Either
A.
A or B, or it should be A.
Yeah,
Either
Joy
A or B.
B.
What you're gonna look at is the cost, not the head.
Okay.
If you're converting any insurance to another insurance, you're gonna check the cost. That's why I say to you as a person, what do you consider? Whatever you are doing in this world, as far as it involves money, you have to think about, can I afford it? If you remember, if your term insurance, by the attained age, the premium cost will change because the premium will not be based on your new age. So it may not be affordable then. So cost is the most important thing you consider. P is looking to purchase a life insurance policy that will pay a stated monthly income to his beneficiary for 20 years after he dies, and a lump sum of 20,000 at the end of that 20-year period. What type of policy should be purchased? After we discuss all this, I know we have discussed family income, we discussed family survival policies, discussed maintenance, and we discussed family benefit policy too. Is there anything like
Maintenance
family benefit
policy.
policy? Somebody says C. I
Yeah.
think Austin says C. Any other person?
Yeah.
It's family maintenance. Then when do we consider family income policy? Can anybody tell me? When do we consider family income policy? Can anybody volunteer to say something on family income policy so that we will know all it means? There's nothing like family benefit policy. There's nothing like family survival policy. So family benefit policy does not exist. Family survival policy does not exist. What we have is family income policy and family maintenance policy. So I'm not saying, can anybody say something about family income policy?
The family income policy provides regular monthly income after the policy owner has died.
Mm-hmm.
That's all I know about
all
it.
right. So yes, you are right. I want everybody to remember this. The only difference you have to attach to maintenance and family is the issue of lump sum after you have paid up the monthly, the lump sum. The lump sum only exists in maintenance. In family income policy, there's not like a lump sum. The money, if it's 200,000, they're paying them monthly 200,000 until the amount finishes. But in maintenance, they be paying until when the amount finish, they now pay the lump sum. All right.
Okay, so the difference is in family maintenance, there's lump sum. Okay.
Yes, attached to the benefit. So a company that owns a life insurance policy on one of its key employees may do all of the following except. I've talked everything about key employee policy. So now you say a company that owns life insurance policy on one of its key employees may do all of the following except what? So invariably, if you are the policy owner, what will you do? What can you not do? So forget the word key employee or
B,
that.
bravo. B as in bravo.
All right. Of course, if you're a policy owner, if you have a policy to your daughter or to your son, you can cancel the policy if you like. You can borrow against the cash value, of course. You can change beneficiaries, your duty. But can you change the policy interest rate? No. So you see why they use these key employees to confuse you. They are talking of policy owner. They use the key employee to confuse you. No, the company is the policy owner here. That company can do all this except changing the policy interest rate. They cannot do that. Now, under a graded premium whole life policy, what happened under a graded premium whole life policy? Graded premium whole life policy. Remember why it's called graded? Why it's modified? And you have to remember the two, modified whole life policy and graded premium whole life policy. So what happened under graded?
Is B.
Any other person?
It's B, bravo.
Oh, yeah.
It's B. So can somebody say something about modified?
Yeah, in modified.
Uh-huh.
The at the beginning, the death benefits decreases. After some time, it increases, but it will not be fixed.
All right. So in modified, the death benefits, I mean, the premium is premium. Premium will be small at the first time, low.
Yeah, premium, rather.
Then after about 2 to 3 years, it increases and remains the same till the end.
There's something I want to add to graded. In graded, the premium increases annually.
Yes, in graded, the premium increases exactly what I want to correct you.
Yeah.
In graded, the premium increases annually until it reaches a point that it remains the same.
Yeah.
So that is it. So these are the two things: modified whole life policy and graded whole life policy. Please know that is the change in premium. The premium in graded, the premium increases annually until it reaches a point it remains the same. Then in modified whole life, the premium increases. I mean, starting from small, now after about 2 to 3 years, it now begins to increase until it remains like that. So that is how it is. Remember the two. I just brought that one in here. So no, sorry, we didn't answer that. We have answered that. Sorry. All right. So a limited pay life policy has what? A limited pay life policy. If you know all this, nothing will make you not to pass. That's the truth.
A as in bravo.
A limited pay life policy. Say A. Any other
As in
person?
bravo. A as in bravo.
Yes, somebody has. Let me see what this person said. All right. I said a BJ said A too. All right.
I can't see this.
Right, somebody said A. All right, you see, there's something I want to tell everyone. You see, all this type of policy, that's why I took my time to analyze this from term policy. Tell you in term insurance, there's 3 types of policy. In whole life, there's 3 types of policy. In universal life, there's a lot of them. So I take my time to begin to tell them one by one. I even tell you to jot it down. If you know it, you know all this, there is no way questions will not come, several questions will not come from this. That's the truth. For those who have experienced this exam before, we tell you that this area is some of the area that sometimes it's confusing. I agree, it's confusing. But you have to take it step by step to be able to know it. So this one says, which statement is correct regarding the premium payment schedule for whole life policy? The premium payment in whole life policy. How do you schedule the payments? Any answer?
Well, we are still looking at it. Taking B.
Yeah. Any other person?
B as in Bravo.
Any other person? Somebody said, all right, Austin said A. Austin said A. And somebody said B. Any other person?
Either B or D. The question you get as to B or D.
All life is this thing is fixed. The premium is fixed for life. Until
Somebody said B. So some person said B already. So we're gonna take it. Premiums are payable throughout the insured lifetime. Coverage lasts until death of the insured. That is just the answer. See, in a single premium, if you say A is answer, let's say for people who say A is answer, a single premium is paid at time of application. Coverage lasts until retirement. That is not true.
That's not true
Nothing
because
to
it's the
do-
age of 100.
There's not like until retirement there. Let's assume a single premium is paid as, of course, that's you can pay a single premium, of course, but not coverage lasts until retirement. Nothing like retirement. Now let's look at C. Premium are payable until age 65. Coverage lasts a lifetime. That is not true.
That's not true.
D. Premium are payable for a set period. Coverage expires at that point. That is not true. All right. This one say S owns a life insurance policy with cash value that fluctuates according to the underlying investment performance of common stocks. Which of this policy does S own? It fluctuates according to
D.
Any other person? Somebody said D. Any other person?
D as in David.
Yeah, that's whole life. It goes with the stock. It goes with the market trend. All right. K buys a policy where the premium stays fixed for the first 5 years. Premium stays fixed for the first 5 years. The premium then increases in year 6 and then stays level thereafter. At all the while, the death benefit remain the same. What kind of policy is this? We just finished. We just said it.
It's graded.
K buys a policy where the premium stays fixed for the first 5 years. The premium then increases in year 6 and stays level thereafter. So, someone say graded. Any other person?
No. I discontinued. It's not graded.
So, which one is the answer?
Let
me see what somebody put there. Somebody says C. Teresa says C. So, another person? Teresa says C. Another person?
C.
Huh?
I'm leaning toward adjustable.
C as
Like 2 persons say C. So adjustable is not there, graded is not there, variable is not there. Remember, we say modified. Modified, first of all, is stay the same until a particular time it begins to increase. So that particular time is after that 6 years, it begins to increase. That's the definition we gave before. Variable whole life insurance can be described as what? Variable whole life insurance can be described as what?
Security product.
Any other person?
Yeah, security because of stocks and stuff.
Guys, which answer do you choose?
B, security.
Austin says C. Any other person? Somebody said D. Oh, somebody said B. Some other person puts B. All right. Austin said B. Yeah. All right. So 2 persons say B.
Okay.
It's good you give there as a variable product. Remember, I said it's a security product, and equally a whole life is a variable insurance.
Yes,
So
you
it's
did.
both an insurance and a security product. I think it's not too long I said it. When you see variable, remember, you can see variable as a security product. You can see it as a life insurance product. That is why the previous answer we gave, let me go back to it. All right, look at this answer. Variable whole life insurance. Here, variable is not security product. It's a whole life insurance. So you come to this one. Variable now is a product, is a security product here, is equally an insurance. So that's why I say whenever you see, look at the word. If it's product, they're talking about product, then variable product, taking off security. But however, we have variable whole life insurance. Please. So which of this type of life insurance allow the policy owner to have level premium and to also choose from a selection of investment option? Which of this type of life insurance allows policy owner to have level premiums and to also choose from a selection of investment options?
Adjustable.
Any other person? Somebody
B as in Bravo.
somebody chooses answer. Somebody say D, and the other person say B. So we need 1 person to confirm. Somebody say one say B,
I
one
said
say
B. I said B as in Bravo.
Yeah, you say B.
Yeah.
All right, 2 persons say B. All right, let's go ahead.
I mean D.
Variable life. Which of these types of life insurance allow the policy owner to have a level premium to also choose from a selection of investment options? Can modified whole life do it? No, of course no.
No.
Adjustable life cannot do it. It's only the variable life can you talk of investment and equally talk of insurance. Please. It's only variable that you can talk of investment and also be talking of insurance. We say insurance is not an investment. However, does it accumulate? Do you use it to save? Of course. But if you use it for investment, it's left to you to decide. But by law, it's not an investment. Life insurance is a protection portfolio. It's not an investment portfolio. So, but when you talk of variable, you're talking of both investment and insurance. So please have it in your mind. Don't be confused with that word variable. You can on your own read it and get more knowledge about it, please. So you not get confused about it. So we are done with chapter 4. This chapter 5 is very, very important. Chapter 5 is life insurance provisions, options, and riders. It's one of the chapters you must know. It has a lot of scenario questions. It's one of the chapters you must, in fact, before you go for that hall, you must know it. At least you must know greater percentage of things that are in there for you to pass it, because most questions will come from there. Is life insurance policy provisions, options, and riders, what they are. That's exactly what we're going to see on this chapter, chapter 5. So let's begin. It says, imagine you purchase a life insurance policy. You purchase a life insurance policy today. The agent, which is you, hands you a thick document filled with provisions, clauses, and riders. While it might seem overwhelming at first, understand this element is crucial to making the most of your coverage. So, what element are they talking about? What do you think that agent hand over to you? Who can answer me? Who can answer me? What do you think that this guy is talking about? He said, you are the agent. Imagine you have purchased a life insurance policy from an agent. You come to me today. I'm an agent already. I wrote a policy for you. Then after some time, I come to your house. I deliver a very thick document to you. And inside that document, you have a lot of provisions, clauses, and riders. I deliver it to you. They say, I'm asking now, what do you think is that document that I deliver to you?
It's a policy now.
Huh?
It's a policy.
Of course, it's your policy booklet.
Yes.
You purchase a policy, they deliver the policy to you. Remember, this document can be delivered to you by mail or by hand. The agent can deliver to you by mail, and it can deliver to you by hand. The agent can come by hand and give it to you. However, they can send it to you by mail. So we have two things we know. I want everybody to know, but I don't want to rush it now. One is that when that agent delivers that policy to you, you have what we call free look period. We're going to say it. When he delivers that document to you, that thick document to you, you have 10 days to go through that document to be able to say, I want it or I don't want it. To be able to make so many amendments on that document. 10 good days. If it's handed over to you by hand, you have 10 days. That 10 days is what we call free look period. Now, if the booklet is delivered to you through mail, nobody comes to you to deliver it. They send it to you through mail. You went to your mailbox, you got the document. You have what we call free look period, 30 good days or 31 days to go through that document. So these are the things, the free look periods, we're going to see it here, but I just will preempt it what we're going to see. So that document they're talking about is your booklet of the policy, delivered to you either by mail or by hand. So life insurance policies are carefully structured contracts that balance the interests of both the insurance company and the policy owner. So life insurance company, contracts between the insurance company and the policy owner is two people that are involved in the contract, the policy owner and the insurance company. However, you can still say it's a contract between insurance company and the insured when the policy owner is the insured. I hope everybody understands that. When the policy owner is the insured, then it's contract between the policy owner or contract between the company and insurance company and the insured when the policy owner is the insured. Now, it's a contract between a insurance company and the policy owner when the policy owner is not the insured. For instance, a juvenile policy, or however, a policy you put for your parents, for your for your uncles, for your nieces, for your cousins that are above juvenile. All right. So in this chapter, we are going to explore the standard provision found in virtually all life insurance contracts. This is a very serious chapter. So these provisions aren't just legal jargon. They are important safeguards that protect the policy owner and the insurance company. For example, the contestability clause prevents an insurer from denying a claim after a certain period, the incontestability period. Now, even if there were misstatements on the application, meanwhile, the suicide clause protects insurer from individuals who might purchase policy with the intent of taking their own life shortly afterward. Now, we have also to examine various options that make life insurance policy flexible financial tools. So from policy loans that allow access to cash value to dividends, option that can enhance coverage or reduce premium. These features give policyholders significant control over their policies. Finally, we are going to look at riders, optional add-ons that can customize a policy to meet specific needs, whether it is providing income during disability, guaranteeing the ability to purchase additional insurance in the future, or covering family members. Riders can significantly enhance the value of basic policy. So we're going to try to get all these. We're going to try to understand those. So you can see that in this particular chapter, a lot is in there, a lot. So, and believe me, I think for those who have written this exam before, we confirm to you that this chapter will contain greater part of the questions. If you have written this exam before, go to the paper they give you, check on the life insurance policy provisions, options, and riders. You will see that it has a long stretch, which means what? A lot of questions will come from it. So that's what we're going to see on this chapter. Let's watch this video so that I think we're almost done for the day.
Glad you're back. You've already built a solid foundation in the basics of insurance, and now we're ready to take things further. In this chapter, we're diving into one of the most practical and powerful parts of your training: life insurance policy provisions, options, and riders. These are the tools that make policies flexible, protective, and tailored to real-life needs. So let's connect the dots between these elements and the kind of coverage your future clients will depend on. Stick with me, and you'll be more than ready to pass with confidence. By the end of this chapter, you'll be able to identify standard provisions found in life insurance contracts and explain their purpose. Describe how clauses like incontestable suicide and misstatement of age protect both insurers and policyholders. Explain policy ownership rights and how assignments work. Compare non-forfeiture options like cash surrender, reduced paid-up, and extended term. Understand how policy loans function and their impact. Evaluate dividend options and how they benefit policyholders. And finally, recognize common riders and exclusions and when they apply. Life insurance isn't just a promise. It's a contract. And like any contract, it's built on provisions that define what's covered, what's not, and how both parties are protected. We'll start by breaking down the standard provisions you'll find in nearly every life insurance policy, like the entire contract clause, the incontestable clause, and the free look provision. Then, we'll explore how policyholders can customize their coverage through riders, like waiver of premium, accidental death, and guaranteed insurability. These features aren't just for passing your exam. They're tools you'll use to help clients make informed decisions about their financial protection. So get comfortable and let's dive into the world of life insurance provisions, options, and riders. You're one step closer to becoming a licensed insurance professional.
All right. So that is what we're gonna see. So what we're gonna do is I think, let me see. We're gonna go through the keywords. Probably we're gonna start keywords in the evening by 6 p.m. I think we have tried today. We're gonna do I implore everybody to make sure you log in to this chapter. It's very, very important chapter that everybody has to be part of. Understand it, ask questions to understand it, a lot of questions come from it. A lot of questions come from it. So I want everybody to be part of it. We start it in the morning. I mean, in the evening today. Probably we'll go half of it today. Then tomorrow morning we finish it up. If we can, it's a lot of things. It has a lot of questions, and not only questions. It has a lot of questions that have scenario questions. And you know, in the exam, scenario questions is always a big problem. If you do not understand the words, you cannot understand the scenario questions, and that's where most people mess up. So please, let's see in tomorrow. I mean, this evening by 6 p.m. And remember what I said before. We appreciate everybody to come to Dallas. We have a provision, your hotel accommodation. We have your hotel accommodation paid for. So what you need to do is to contact the person who brought you to the business, your business partner. Contact that person, register for the conference, give us your information. We want to know, we want to conclude, because the Champion Bowl is coming up February. It's almost 2 weeks or 3 weeks from now. So we need to get all the information. We have to complete our hotel booking this week. So the earlier you send us your information, the better. So just get your tickets, your air tickets. That's what you need to only get your air tickets. Come in, we have our hotel accommodation for you. Again, for you to come in, you have to register. The tickets for the entrance have already been paid for you. So what you need to do, meet the person that brought you to this business, ask the person for your own ticket for entrance. The person is going to give you a ticket. Then you have to come as an agent, register. We have a lot of fun things to do. In fact, Friday of that day, I think that was Friday. Yeah, Friday, we have a massive party where everybody, I think the person who brought you will give you an outfit you're going to wear. It's very good, very sweet thing. It's an occasion that you enjoy. You don't want to miss it. First, some people, I have some medical doctors, they call it enjoyment conference.
Okay, the person will give me what to wear.
No, what to wear is what I mean is that the dress code for the party. Dress code for the party. Of course, I think you when you come in as an agent, I think there's a t-shirt. Of course, there is a t-shirt. Yeah, I know that. There's a t-shirt that will be given to everybody who attends. So just come and be ready to meet all the providers. All those providers, all those insurance we are talking about, insurance. Come and meet the providers. If you have questions, ask them. We have a lot of providers that are going to come. The people who started WFG is going to be there. So just come and experience Dallas. It's very great thing, honestly. If you come, you don't want to miss it another year. I tell you the truth. So we expect to see everybody at Dallas, starting from February 5th to February 7th. So see you guys in the evening by 6 p.m. Thank you and God bless.
Thank
Bye.
you.